if you sell and you can't average 10% cash on cash return, you've done a pretty poor job. And I would call that a failure overall. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always on these Wednesdays, we got Matt Jones. Matt, how are you doing today?
I'm having a great day. How about you, Todd?
Oh, man, that's fantastic. Congrats on the great day. I'm having a fantastic day too, man. It's every day is a Saturday, as it goes, right?
Yeah.
Yeah, love it. Love it. Well, we just got back from touring properties in Lexington and Kentucky. We looked at a couple of properties. We have an opportunity to purchase. We'll see where those go. Of course, you just never know. We're still buyers, even though the market's kind of crazy. So many unknowns. We've talked about that in the podcast. We'll talk about it again in the future, but there's a lot of unknowns going on, but we're still net buyers. Still looking to expand and grow, just obviously very strategically and carefully right now. So that was great. Toured several of our buildings that we've got in Lexington and Kentucky. We've got a new one, Matt, that we're closing on here in about a month. And so we actually just did our capital raise, which was really cool because we filled that in 24 hours. So that was really fun. It was a 506 B, so we weren't able to advertise or anything. So we just sent it out to our current kind of investor network and people that are on our investor list as prospective investors that we've had, conversations with and have talked with before. But we were able to fill it really quick, which was fun. So, but always great to get to these properties and kind of see the progress that's happening. It's funny, we were just talking about that. We're talking about hiring an asset manager, and maybe we should do one of these podcast episodes soon on asset management. We were talking about hiring an asset manager, and because we are our asset managers. Myself, I kind of run it, but Matt and Drew, my partners, also really help out a lot with the asset management. It's funny when we go to these properties and you just walk, and it's interesting. And I think it was Drew that said this. There's a saying out there that if there's a piece of trash at the property or somewhere, there's a piece of trash and an employee walks by it and they don't pick it up. Once they walk by it 3 times, they'll never pick it up. It just becomes a part of a fixture. It's a fixture of the property. They don't see it anymore. That goes with trash. That goes with probably peeling paint or, whatever it is. They just don't see it anymore because they're so used to it. They've trained their eye that this is what they're supposed to see. And so it's always good to have an eye that's not at the property very often, or ever on a daily basis, at least, go by there and go, hey, you see this, see this, see this. We need to take care of this. This isn't how we want to do things. Just even gentle reminders of this is how we run our operations. So always good to be able to do that.
No, important to create that culture of caring where the employees take ownership of their situation.
100%. It drives me nuts to see. It's probably a part of my, ADHD. It just drives me nuts to see like the little things bother me. It's like, just clean it up. It doesn't take very long. Pick up the trash. There's a mattress sitting there. I know a resident dumped it. It's not you that did it, but that mattress is sitting outside of the dumpster enclosure. Looks horrible. Mm-hmm. Let's take and move that inside the dumpster enclosure. It looks trashy. We look like we have a property that nobody wants to live at. So let's take care of it. I want my properties. They don't have to be perfect, but I want them to be very visually appealing to people.
Yep. Awesome.
All right. So that's not what we were talking about today. Matt, what are we going to cover?
We are going to be talking about why some real estate investors fail.
Yeah, man. So first of all, I think it's really important to understand that most real estate investors don't fail. It's very rare to see a failing real estate investor. And I think there's probably more failure in certain types of real estate than others. So quickly, we should probably cover that. And then we can dive into the reasons, because these reasons, quite frankly, they're associated with all types, whether you're buying a multifamily building or a retail center or an office or a single family house. You'll fail if you do these types of things. But when we look at the failure rates of buildings, and I would call failing a couple things. Foreclosure, of course, is the most obvious failure if you get foreclosed on, but also selling at a loss is a failure, or even just selling and making very little profit, or holding and making very little to no profit. If you own your real estate and you're not able to make at least 10% on your money, now I'm not saying you have to make 10% cash on cash return. Maybe that's 5, 6%, 7%, 8%. But if you sell and you can't average 10% cash on cash return, you've done a pretty poor job. And I would call that a failure overall. Right. So when I look at the property types and I look at the highest level of failure, and there's a reason for this, and that's some of these things we'll talk about, but the highest level for failure is going to be in single family homes and duplexes. Okay. You look at the last foreclosures, the crisis, 5-6% of single family homes got foreclosed on, where less than 0.5% of multifamily got foreclosed on. 5+ units is multifamily. So single family homes, multifamily is definitely one of the lowest, along with industrial. Retail is fairly low. Office is creeping up. It's definitely been on the higher radar recently. But most commercial overall, Matt, is pretty low on the foreclosure rate. And I would say probably pretty low. And these aren't statistics, I guess, but pretty low on the failure rate, how I just earlier defined it.
Yep. And that's fair. And I like your point about the small stuff. I mean, I think there's just isn't enough cushion with the single families and duplexes and that kind of thing to handle it when things go wrong.
Yeah. So that's a big reason people fail, is the cushion. Okay. And so single family, there's not enough cushion. And I would say the other thing is most people aren't running it like a business. So those are two of the things that we'll hit on both of those. So first of all, the cushion. What do you mean by cushion, Matt?
Well, if there's, if something has enough cash flow to cover your expenses, that's great. And when you have more units, there's more, cash flow as a result. But I think it's moreover, with a single family, if you don't have a tenant in there, or if you have a tenant who's non-paying, you have essentially a 0%, income that's coming in. Mm-hmm. And then what happens then? Because you still have all your bills that you got to pay.
Yep.
And then it just goes downhill. And if it's a duplex and you've got one vacant unit and one occupied, then you've got a 50%. Whereas if you got a 100-unit place and there's one unit not paying rent or is vacant, you got a 99% vacancy, or I'm sorry, 99% occupancy, and so like one unit doesn't make a difference in that large multifamily.
Yeah, we'll stick with multifamily, but this is very similar to commercial as well. Commercial rents by the square footage. And so it's very similar. If you got more square feet, you got better income, you've got better chance of getting, profitability. But with commercial too, a single bay always would make me nervous. Single tenant would always make me nervous, because if that tenant goes away, then we're left with the entire building vacant. So I like the idea of multiple tenants. But there is an advantage of having a single tenant with a commercial, and so it's a slightly different than single family. But either way, it's all about the square footage of the property. So when I look at a single family, you've got 1,000 to 3,000 square feet for most rentals. Where if I look at an apartment building, you got 100,000, 200,000, 300,000 square feet. You look at a commercial space, you got 50,000 to 200, 300,000 square feet. So we got a lot more square footage, which again, that's going to allow you to have more cushion there. The cushion is your cash, right? Your cash at hand. That's another big cushion. And so why people fail, they don't. All right, we'll stick with kind of your general thesis first, which is 100% accurate. People fail because they don't have the cushion, because let's call single family home, and this could go to any kind of deal, but you have more expenses than what you oftentimes think, right? It's so easy for those expenses to add up. Let's think about it. This is a true story. This is me. This is one of my properties. True story. Okay. Luckily, I had a portfolio, so I was able to cover the negatives with other properties. Okay. So this property, we had a sewer line that broke, and we had to dig up the street. Dig up the yard and part of the street to fix the sewer line. It was $12,000. Okay. Just a couple of years later, I had a roof that needed to be replaced. So that was, I think it was like $6,000. I think it was 2 years after that, the same year, I had a refrigerator, a stove, and a water heater go out. Okay. Yeah. So this is all within like a 4 to 5 year time period. I had a $12,000 repair. I had a $6,000 repair. And then, fridge, stove, and water heater, call that maybe roughly $2,000. Okay. So I have $20,000 worth of expenses on that property. That's a single family home. I got $20,000 worth of expenses. I did not make income. That income on that single family home was about $5,000 a year. Okay. So that wipes out my income, Matt, for not 1 year, not 2 years, not 3 years, but 4 years. I finally break even on that property. Now, I thought I was doing really well in that single family house, right? I'm making $5,000 a year. I'm making that year over year over year. And all of a sudden this happens. And now I've got $20,000 worth of expenses over a small period of time. I make no money.
Oh, how frustrating. And you got to be thinking to yourself, man, when is this going to end? Like, what's next?
And think, Matt, if most single family owners, see, a lot of people think about their cash flow as what they've got on paper. Okay. But it's actually what reality happens is what comes in your pocket. So most people that own single family homes are probably making $100 to $300 a month. Okay. So if you're making that, let's call it in the middle, $200 a month, you're making $2,400 a year. If you have $20,000 worth of expenses that happen in a short time period, you're looking at 8 years just to break even. So that's the scary thing to me about small properties, is that they can quickly erode your cash flow. Where if I've got a sewer repair on a multi-unit building and it's 200 units and it costs me $12,000, that's nothing, right? I take $12,000 to divide it by 200. I got $50 a unit.
Yeah, and with a single family, you generally don't plan to have $20,000 worth of reserves sitting there in a bank to handle expenses.
So that leads us to cash. What do you have in cash reserves? So with a single family house, you definitely need to have a larger portion of cash reserves than what you do with a multifamily, as far as percentage wise of your income, right? Or your NOI. Okay. So when I look at the NOI and I look at, so with my multifamily, we want at minimum, we want 6 months worth of reserve on our mortgage payment. Okay. So if I take my mortgage payment, I want minimum to be able to pay that for 6 months. That's a very minimum. Depends on the property and what's going on. I usually am more like 9 to 12 months. Okay. But if I've got a really, really good, pristine condition property and all that, 6 months might do it. But we're looking at 6 to 9 up to 12 months. With a single family home, I really believe you should probably have about 18 to 24 months worth of reserves if you want to actually be successful. Most people do not even come close to that. Okay. So that's my thought, is I would like to see probably closer to that 24 months worth of mortgage payments set aside, sitting in an escrow account, right? It can be an interest-bearing account. You can put it in a money market. You can even invest it in, I guess if you invest it in stocks, it's a little riskier, but you can invest it in, some safer investments. So you're not just sitting on just a ton of cash, but cash is king, right? Cash is king. Warren Buffett right now is sitting on billions and billions of dollars worth of cash. I think like a ton of, like, it's not just Warren Buffett, his companies, they're sitting on billions of dollars, like hundreds of billions of dollars of cash right now. They do it for a reason. Cash is king. And when things get rough, cash takes care of those issues.
Yep. And also when the opportunities come knocking, then you're ready to answer those.
Yeah, 100%. So, but it's Matt, as far as a multifamily investor, look, I'm a multifamily investor, Matt. I'm a real estate investor. I syndicate, right? And so I have to show my investors good returns. My investors want to see that we've got good returns. Well, I can make my returns look really a lot more attractive, Matt, if I reduce my reserve account. And we're doing a deal, like I said, we've got $1 million worth of reserves, or nearly $1 million worth of reserves. Nearly $1 million worth of reserves. If I made those reserves, I could be on the aggressive side and probably drop those reserves down to $200,000. Most of my investors wouldn't even blink. They wouldn't know that I'm being super aggressive. They wouldn't think, oh, he just dropped it to 200,000. Wow. Ooh, I don't want to be in this deal. No, most of them don't even see that. Because I wouldn't, if I did that, if I was that type of person, I probably wouldn't even really mention it to them. I'd be like, oh, we got some reserves, kind of glaze over it really quick. But what happens there is my returns look really good, because now I have to raise less money. Because if we have $1 million worth of reserves, we got to raise all that $1 million from our investors. But if I drop that down to, let's call it 200,000, now I only have to raise 200,000. I save $800,000. That means all my returns are based on, instead of 5 million, they're based on 4.2 million. All of a sudden, my investor returns go from a 16 IRR to 17 IRR, 17 and a half IRR. It looks really good, but their money is highly at risk because I don't have enough cash to stand any kind of variation going on.
Mm-hmm. Yeah. Any another pandemic that happens and people stop paying rent, natural disaster. I mean, whatever things that are out of control can happen. And then your limited reserves that you have in that kind of situation get dried up super quick. And then what? Like you try to do a cash call, or you have to sell prematurely. I mean, it's a fail.
Yeah, you're sitting there in panic, and trust me, guys and gals listening, like the money can go fast. I've purchased properties where we've had problems, and that money can rip really quickly, and all of a sudden those cushy reserves that you thought you had are gone. So if you have, make sure you feel like you have way too much reserves. You never want to feel like, do I have enough reserves? If you're questioning if you have enough reserves, you don't have enough reserves. I always have to feel like I've got too much in reserves. That's a better position to be in. So next thing, Matt, cash flow, right? We've already kind of talked about it, point one, but cash flow, you need to be making money on cash flow. That's how people fail in real estate, is they think that a real estate investment is about buying a property that appreciates in value, and eventually they're going to get that value out of it, and then they'll sell it, and then they'll be rich. Okay. But they forget the probably number one thing for successful real estate investing is cash flow. You have to have cash flow. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.